Hey everyone, thanks for joining. We're just going to get going in a couple of minutes while people just join. If you want to get a glass of water, now's the time to do it. Hey everyone, thanks for joining. Hopefully you can all hear me well. Sorry about if this camera is a bit light. I'm right under a light at the moment. I'm in a hotel currently. I'll just get everyone from Xact Accounting to jump on. They should all be on the line still. Yeah, we've got Phil, Josh, and Suze. Awesome. Josh,
hey, Jules.
Morning, good morning.
Hey guys, how are you?
Good.
Excellent.
Brilliant. So, guys, we'll come into the content and everything today about what we're going to do, but I just wanted to have a chat to the people on the call here. If you haven't met me before, I'm Julian from Buildxact with the estimating job management software. Obviously, this webinar is direct to Bunnings customers. So what we're going to do is just talk through some of the tax time tips from the people that actually know about tax. I will not be giving you any tax advice at all. And if you do hear me give you any by any chance, make sure you
delete. We'll stop you, Julian.
Stop you. Put a disclaimer.
Not listen, because I think Josh is going to help me do mine this year. So yeah, don't any situation. But one of the things I do want to talk about, for those who don't know me and hasn't heard me talk on these before, I used to work at NYB. When I was at NYB, I used to look after bookkeepers and accountants, ultimately trying to get people on NYB software, all that kind of stuff. But we talk to bookkeepers, accountants about their business and things that they should be doing. And one of the biggest issues that I found in the space was the amount of people that just worked under 100 different industries: manufacturing, trades, construction, retail, hospitality, etc. And what we tend to find is that people that try and spread themselves really, really thin can, it's that whole jack of all trades, master of none, is that the people that do that can never really get into a whole heap of detail on that particular area. So when it comes to giving advice to their customers and clients, it just was really difficult for them to give them proper advice. And if you kind of imagine how bookkeepers and accountants used to work, a lot of it was data entry and tax time stuff, and not really much deeper than that. So at the time, and you guys obviously attest to this, it was easy to be really widespread, but the industry has evolved now. So kind of the point I'm making on this is that if you are picking someone in your business, whether it's accountants, bookkeepers, marketing gurus, all these kind of things, try and pick people that have very, very specific experience in your industry. And this is why we work at Buildxact really, really closely with Xact Accounting, because they specialize in that construction space. They come to a lot of events with me. I'm seeing some of the guys here today in Gold Coast at the Master Builders Roadshow event. So they're really, really well versed in that space and understand the specifics about how construction businesses differ from, hospitality, for example. So I've probably done a little bit of an intro there, but Phil, do you want to jump in and just do a broad intro about Xact Accounting?
Yeah, and look, just Jules and I are going to do a bit of a co-host double act today. Some of this content gets a bit tricky, so we're going to share the hosting responsibility. So I might just sort of pick it up from there, and I might just share my screen, and hopefully the technology gods are going to be kind to us all. Can you guys see that okay?
Yeah, perfect.
Okay, brilliant. So yeah, let's go. So today we've got the great pleasure of joining you guys. As Julian said, we work really closely with Buildxact. We're both in the same kind of space. And we take a real kind of specialist view when it comes to accounting in this space. Today we've got Suzanne Faulkner, and Josh. Josh, I've left off your chartered accountant's badge there, mate. Apologies.
Goodness.
But they're both chartered accountants. They're both partners in the firm. Well, all three of us are. And really been doing this thing for quite some time now. So we've got a lot of expertise on the call today. Just quickly on us, we do 3 core services. We do bookkeeping, which, Jules was talking a little bit about that just before. It's not just, pushing some numbers around a book anymore. It's as much about system integration as it is about the actual financial side of things. So, there's a lot going on in that space for us now. We do compliance, which is tax, structuring, licensing. So a lot of that sort of, home warranty, QBCC licensing, we get pretty involved in that. And we also do a service called CFO Advisory. This is not so much tax accountant. This is very much commercial accounting and working with clients to grow profit. That's what those guys are focused on in CFO Advisory. Our clients, they are usually scaling up. They often have a growth mindset, so they want to learn more about how to run better businesses. Thank you for coming along today, everyone, because you are obviously doing that if you're joining a call like that. It's time for a specialist. So they're after someone who's not just a generalist accountant. They're after someone who really specializes in building and construction. And they really want like a finance or accounting running mate, like almost like a partner in the business, because they don't necessarily have that expertise in-house. A bit of housekeeping for today's session. So the agenda, I'm just going to quickly go through a couple of first principles, and then we're going to get into the actual tax side of things. That is structured as a journey. So we've got content for beginners, people who are really starting to get there, and then people who are nailing it in their business. So hopefully, depending on where you're at in the tax journey, there should be something for everyone today. We're going to run some polls throughout, just to try and keep people awake and interactive, but also as a way for you to follow up on any of the content that we've talked about today. So that will be, rather than having QR codes and things like that, that will be the way that we're going to be able to make sure that you can get in touch with us afterwards, is via those polls. Questions, drop them into the chat as we go. We're happy to do that, and we'll be keeping an eye on those questions as they come through. We're also, though, going to stop at the end of each section, those 3 sections, so that you can ask questions on the content that we've just covered in that section. I just wanted to make a note. Sometimes we get some really technical stuff on these sessions. We'll have a go at that. Although if we think it's going to lose everyone else on the call, we're not going to get too bogged down on those sort of really high level or really, very complex technical tax questions. This is about trying to really make sure that people get the most out of having, Josh and Sue's really valuable resources, ask the question that they really have always wanted to ask. Might feel a bit silly asking it, but really please make sure you do ask, because today is the day to get those kind of questions answered. This is a disclaimer. This is not advice we're giving you today. This is general information. We're going to go through some examples along the way that have been simplified just to kind of make the point. But obviously with things like tax and finances, it always depends on your specific circumstances. So make sure you get some specialist advice from a lawyer, accountant, other professional services before doing anything. So before we begin part 2, this is one of our first principles. We balance, there's 2 competing interests that we're trying to balance when we look at tax. There's the tax strategy side of things and the commercial strategy. So we don't recommend you do something just because there's a tax advantage in doing it. It might not be good for your business to buy a car or to spend money coming into end of financial year if you've got cash flow issues, for example. So we always try and take a balanced approach between what's good from a tax perspective, but also then what's commercially good for your business as well. The next thing we're trying to balance is what you're actually able to do in law and what the opportunities are from a tax perspective. So we're proud of being able to take our clients as far as they can possibly go in terms of saving tax, getting the best outcome they can, but we also want them to sleep well at night and not have the fear of what would happen if my business was audited. We are not accountants who are going to turn the blind eye. You can go to someone else for that. We like our clients to be really shipshape when it comes to tax, but to do it very well and make sure that they get the best possible outcome. And then the final part with these principles is, again, it's good that you've turned up to the webinar today because it means that you actually care about getting this part of your business and your affairs right. It's really important that you take an active role with your accountant to build a tax plan every year and look at that through the year as well to make sure that you are getting things right. There's no point working like stink every day to generate profits in the business and then have to part with those profits to the ATO any more than you need to. So, but that's a proactive thing, and we love working with our clients to save them every last cent that we can. As I said, we're going on a tax journey today. So we've got content that we're going to cover for the newbies around how to set up, get your foundations right, and some of the basic kind of expenses that we deal with all the time. We've got getting there. So these are people who are actually, they're out of the beginning stages and they're really starting to get there in their business. And we're going to cover off some more interesting content for that category. And then finally, for those people who are nailing it in business and have generating some really decent profits, what are the things that we can do to make sure that we're not having to hand over any more than we want to in that space? We're also, and this is my fun little animation, we're also going to quickly touch on anyone that is on fire from a tax perspective. We've got a really good solution for that that's in play that we've been using quite a lot lately for those businesses who really are struggling with ATO debts and the like. So that's it. I'm going to hand over to our my excellent colleagues to kick us off with the rest of the content from here.
Let us start our journey.
Just before you do that, was that not an ambulance?
It was an ambulance, yeah. Oh, it's supposed to be a fire engine, isn't it? Julian, I really should run all this content past you for consistency, shouldn't I?
I was looking at it and I was like, I'm pretty sure it's an ambulance.
It was because of the fire. Now they're in the ambulance, right? Okay, yeah. All right, Josh, I think we're over to you, mate.
Actually,
Sue.
Yeah, I think it's
Sorry.
me, but
Suze, go for it.
Thanks, Phil. So as a newbie starting out in your journey in terms of your business and where you're going, often we will see most of you will start either as a sole trader or in some cases may even start in a company structure. So to head up this section, we're really mostly going to be talking along the sole trader lines. And we normally see companies will come into play as your business starts to grow and you start to move things closer into that sort of space. We do sometimes see partnerships in this space as well, but less and less common these days. And they do still pop up. So I guess there's a couple of things here we're looking at, pros and cons of both. The main thing with the sole trader, it is really inexpensive to set up. You just go and register your ABN and off you go. That's effectively it. You may or may not even open a separate bank account. Entirely up to you, although your accountant will probably say, please open another bank account so that you're separating at least some of that out. But the other side of things, the cons, we often see there's all your risk is mixed in together. So all your assets are tied up together. There is no asset protection. There's no separation between your business assets and your personal assets. And we do see quite limited options when it comes to tax optimization. And what we're talking about there primarily is the marginal tax rates. So if you're operating as a sole trader, you are caught in the marginal tax space. That means as your income grows, your tax rate grows with it. And you could be, if you're earning up in those higher amounts, being taxed up at that 45%, 47% bracket. So just be wary that there are limitations in terms of that when you are a sole trader. And if you are starting to edge up into that space, you might want to consider a company. And that's, we'll talk about that a bit more as we go today. But that's certainly a conversation that you should be having with your accountant around about this time of year in terms of, is it time to restructure? Should I be looking at another option like a company or a trust for trading and going forward? So that's really all we wanted to talk about in terms of where we're starting on the newbie journey with structure. And Josh is going to have a little chat about tech.
Yeah. In the same vein as getting your structure right, from the very beginning, we definitely need to be looking at what accounting platform and getting that hygiene in place up front. So there's a number of different tech stacks you could be using, but ultimately you do sort of lead all roads to Rome back to an accounting platform. And Xero is one of our preferred platforms. It's not only from running your business effectively, it really does help at tax time as well. It helps your accountant help you with minimizing tax and making sure your records are all in place. Now, this technology is getting very clever over time now, and it's all about a connected world and not having sort of manual processes in place. So we've also got two other elements that sort of play into your tech stack, one being sort of receipt capture. There's a few sort of different softwares on the market like HubDoc or Dext, as you can see in our example here. And this is all around creating a integrated and much more effective ecosystem around your accounting in terms of how you collect data, report on data, and as well with Buildxact, and Julian, you can jump in if you need to, is having another platform like an estimating platform. I know there's in building construction, there's a million different softwares and ways that job management and estimating is done. We definitely get behind Buildxact on this. It's a nice clean platform that links in with the Xero ecosystem. And the key thing is, even these days as well, the likes of Dext will link into things like your Bunnings PowerPass accounts as well, and you can pull that data in automatically into Dext, as well as now Buildxact's transition into a nice clean two-way sync process now with Xero and Buildxact, making that sort of connected ecosystem work very well now. So the key point here being, don't look at your tech stack as an afterthought, do it as part of setting up your business. It's an important step.
I think
I think we've got a poll.
Awesome. Yeah. So that was the quick lightning trip through structure and then the technology side of things. But as Josh said, I mean, what we've got on the screen there, that's our preferred stack. All those platforms integrate really nicely together, and they can produce really fantastic reporting you can use from a commercial perspective, to see how you're traveling with profit, but also to really streamline things when it comes to, tax time and making sure that, you're not ferreting around in shoe boxes and things for receipts and the like. Jules, anything you wanted to add there in terms of the reporting and the integration of those platforms?
Yeah, kind of just echoing a lot of what Josh was saying there, guys. Like you want to be using systems that integrate with each other. You don't want to be having silos inside your business where data isn't talking to each other, because although people always have the best intentions of like, I'm going to put it into this system and I'm going to take it out and put it into this system, what happens is you get a late night, you get busy, that doesn't get done, 1 week passes, doesn't get done again, and then before you know it, the data is all old, you're not getting up-to-date information, and you just kind of, like Phil said, ferreting. I haven't heard of that being used before, but I like it. Ferreting around, trying to find the information. And when I talk about Buildxact, obviously that's where I work. We're an end-to-end system for the job part outside of the financial side. And I mentioned there in the chat there that we have the Bunnings price files integrated. So you want to try and keep as much flowing through and integrated as possible. So yeah, with us, you get your price files from Bunnings into Buildxact, you estimate using the live price files, you create a quote, start the job, and then as you're starting to order materials and cost track, all of that information is flowing in and out of Xero, so you're keeping your financials up to date, so you can make better decisions as you go forward.
Jules, can you, I'm your host, so would you mind just kicking off that first poll? So really, this poll is just about, we know that stitching all of these platforms together can be a bit tricky. And so if you want a hand with that, either from Julian at Buildxact, or, we've got a lot of experience in our bookkeeping team around that, getting that whole accounting workflow talking to, and those platforms talking to each other seamlessly can be a bit tricky. So please reach out if you'd like us to give you a hand with that. Righto.
Leave it up for a minute or so.
Yep.
And obviously, anyone have any questions in the chat, feel free to pop them in. We'll be checking as we kind of go through. But I know firsthand a lot of builders, I'm at events all the time. A lot of builders do struggle with getting that whole information talking to each other. So whether you decide to jump on and ask for help or not, just try and make sure that that's what your system, the processes look like in your business.
Righto.
Cool.
We might keep going. We've got a fair bit to get through. So next one is purchasing a vehicle.
So this time of year is often, and particularly the last couple of years, been a really particular time of year for people to consider upgrading or replacing vehicles. And we all know most of the reason why, and that has been the very generous instant asset write-off that we've had over the last couple of years, which meant that if we bought a vehicle, we could claim 100% of that expense in the year that we bought the vehicle. So that, though, has changed this financial year. And we'll come to an example in a moment where we are talking a little bit more about that. But effectively, the things to keep in mind when buying a vehicle right now is that, first of all, the instant asset write-off has been reduced to $20,000. And that means that the vehicle has to cost less than $20,000. It doesn't mean that you get a write-off for the first $20,000 on the vehicle. It means you only get the write-off if it costs you less than $20,000 in total. So any vehicle that costs more than that, which these days is practically everything, is going to mean that you have to fall under what's now called, or what are formerly and now, the depreciation rules, which is the original way we used to do things, where we take the vehicle and say its effective life is roughly 4 years. And so we take roughly a 25% write-off over a 4-year period for the vehicle. So a couple of things to keep in mind with that. There is a luxury vehicle tax that kicks in, or luxury car tax on certain vehicles. That is important to know. It's not something really that we deal with in the tax space. It's actually imposed at dealer level. So if your vehicle costs, I think the threshold's around $79,000 and something, if it costs more than that, you will get hit with this luxury car tax. So it's an additional impost by the government to claim a little bit extra in terms of taxes back to them. So more revenue for the government. So it only kicks in if your vehicle is more than that 79,000 mark. Depreciation, there is also a depreciation limit on certain vehicles, and that limit sits around about 68,000 and something. It's always a few extra dollars that we can never keep up with because they increase it each year in line with inflation. I think it's like 68282 or some random number like that. So if your vehicle costs more than that, again, you're capped for depreciation purposes to the 68,000 number. So you do have to be mindful. If it goes over that, you may not get the full value of depreciation on the vehicle over the life of that vehicle. And the other one to keep in mind is GST credits. They are also capped in line with that depreciation limit of 68,000. So if your vehicle costs 100 or 150,000, you actually can only claim GST up to that 68,000 amount that we mentioned before is the depreciation limit. As I said, certain vehicles are exempt from this, and largely they are commercial vehicles. So your trucks or big earth moving equipment, those sorts of things are generally exempt. So you do have to just be mindful, is the vehicle you're buying an exempt vehicle or not? And you may be caught under these rules if it's not a commercial vehicle. So we've given a really quick example here, purchasing a Hilux vehicle. We've said here drive away price is $50,974, and we've said the effective life of this is 4 years. That means that rather than where we'd had previously, the full $50,974 could be claimed as a deduction. This year we can only claim $11,600, but still better than nothing. That is still a deduction that you can put into this current year. And your GST credit on that would be 4,600 thereabouts. So that's sort of how it's working now going forward. As a sole trader, and as you remember, we mentioned before on the newbie journey, so where you are just starting out, you're likely going to be operating as a sole trader. You have generally two options that you've got in relation to claiming vehicle expenses. The depreciation example we gave just before falls under the logbook method. And I'll come back to that in a moment, a bit more about what that's about. Your alternative is your cents per kilometre method. And the cents per kilometre, it's important to note, is capped at 5,000 kilometres per year. Now, most of you guys are going to be doing way more than that, driving to and from work sites, picking up supplies, all those sorts of things. We see most people doing well, 3, 4, 5 times that in kilometres per year. So it's really important, if you want to maximise your claim in terms of vehicle expenses, to really look at your logbook option instead. Your cents per kilometre does, as I said, cap you at the 5,000. And that means that your cents per kilometre claim is going to be a maximum of 4,250. Even if you travel 10,000, 15, 25,000 kilometres, your claim can be no more than 4,250 under cents per kilometre. If instead we had a look at logbook, and to have a logbook or keep a logbook, you need to make sure that you've kept that logbook for a 12-week period consecutively, and that is a reasonable estimate of what your usage would be over the course of the year. So pick a good 12-week period and make sure you track each of your journey over that period of time. Under logbook, in this example here, we've assumed that you've done your 12 weeks logbook and you've established an 85% work usage for that. We've assumed your fuel is about $5,000 per year. Your registration's about $1,000, insurance $1,500. The depreciation is the one we had on the Hilux before, so $11,600. And we've assumed some repairs and maintenance in there of about $4,500. That means you've got total costs on your vehicle of just over $23,500 for the year. If we then apply our 85%, because we can only claim 85% of that based on our logbook, you can actually claim $20,000 or just over. So I would much rather that in my tax return than my $4,000 cap that I've got on cents per kilometre, because that's going to save me nearly $9,500 in tax. So that's a really, really important example of why we should look at logbook versus cents per kilometre. As I said, this really relates mostly to sole traders. And we'll talk a little bit more about companies down the track. Josh is going to have a bit of a chat about home office.
Yeah, thanks, Sue. So we jump out of the Hilux, we go home, we go to the home office. The question is, what can we claim when we're in the home office? So this area has sort of changed over the years, and it is actually a little unnecessarily complicated, home office claims, to be honest. But there's very similar to vehicle. There's kind of two core areas of a quick rate, so an amount per hour or per unit approach, or an actual cost sort of logbook approach. And that's the first two panels there. So fixed rate or actual cost. There's another part to this as well, which actually overlays on both, of where you don't have a specific place of work and your home office is genuinely the only place of business you have. There's an additional occupancy or the ability to claim the actual house holding costs as well. So we'll unpack these three areas. So the fixed rate as a starting point, it's the simplest form of the home office. So it incorporates everything around internet, phone, energy, printing. So you don't have to then keep all the receipts of those items. It's an all-encompassing rate. So the key thing is keeping actual record of how many hours you're actually working at home. That can be diary records, even your schedule, your calendar. And it's a standard 67 cents per hour worked across the year. Now, in addition to that, if you have any other assets like desks, chairs, computers, all of those sort of other bits of equipment, you can actually claim them in addition under the depreciation. Very similar to what Suze was saying with cars. Depreciate them over, if they cost more than 300, you can depreciate them over their effective life. If under 300, you get an immediate claim for those assets. But the key thing is, if you're going to claim depreciation on assets, definitely keep your receipts for those assets you're going to buy. So that's the real simple form. Similar to the vehicles though, fixed rate keeps it simple to calculate, but it generally doesn't result in the best claim for home office. So if you put a tiny bit more record keeping effort in under the actual cost method, you can get a much better outcome. Now, you're probably going to have some questions off the back of this because it is a little bit confusing on how you calculate this. We do cover this in our ebook as well, in a neat table that you'll see off the back of this webinar. But actual costs, we're talking about actual internet, phone, energy, printing, all those actual bills for those costs. Now, one thing around like energy as an example, you need to look at the hours that you're spending in the home office and essentially look at your energy consumption rate of your actual energy bill. And it sounds a little unnecessarily complicated, but that's how the ATO want to do it if you want to claim the actual cost. So that's around phone, internet. All of those bills anyway have an itemized account in nearly all cases. So you can generally work out the split between business and private usage of those costs. And again, it's based on actual hours. So that's now lending itself towards a logbook approach. So I'll just quickly jump to the bottom point of keeping a logbook for a continuous 4-week period, or you actually keep the actual hours for the entire year. The 4-week period is obviously the simplest way of doing it for a representative period. Now, things like cleaning, I mentioned it separately because it's strangely identified separate by the ATO, is if you get your house cleaned, the cost of the cleaning for the home office space, they just apportion it on a square meter. So how much is that office space as a proportion of the total house for cleaning costs? And very similar for the depreciation, same concept for depreciation, anything over 300 depreciated, anything under immediate claim. Now that's the two core areas of the home office. Now, the extension to both of these approaches is the occupancy costs. And this is where it's very specific and quite strict that you need to demonstrate you have no other place of work to claim these costs. And the core part is it has to be a very distinguished part of your house from the rest of the house that is just used for work, nearly entirely exclusively for work. So once you finish doing estimating, you leave the room, lock the door, you don't use it again until you go to work again tomorrow. And that is then claimed on a square meter. Again, similar to the cleaning, where it's that proportion of the house that's linked to the business as a proportion of the total. And then we start looking at claiming things like the mortgage interest, if you're renting, the rent, council rates, water rates, all those other holding costs. But you do have to meet strict requirements that you can definitely show that this area is exclusively for business. Now, the big beware around this, if you own your home or have a mortgage on your own home, typically when you sell your own home, your main residence, it's exempt from capital gains tax. Now, if you start claiming occupancy costs, it can impact your main residence exemption, and you may end up with a result of having capital gains tax if you sell your home. So be very careful. The key message here is get advice from your tax advisor before you just go ahead and start claiming this. It does need to be calculated in a very specific way anyway. But that's the long and short of the home office. Again, as I said, it's in our ebook. There's a bit more information around it. But if you have any more questions, you can reach out.
Bad debts, we're just going to talk about really quickly. It just is a really good time of year to have a look at that and revisit whether you've got anything sitting there that you've been trying to claim in terms of payments from your customers that you haven't been able to recover. So here's a couple of just basic rules around that. Typically, we'd like to see that they're older than 12 months. You've actually made a reasonable attempt to recover that. What reasonable looks like is really based on your own circumstances and how your policy around following up your receivables. And depending on circumstances, this could actually be quite significant. If you've had a couple of invoices sitting there for a little while now that you've been trying to recover and haven't been able to, you may have the opportunity to write that off. We'd always recommend that this is done prior to 30 June. So it's a good time of year now to have a look at that, or at least have a look at it sort of mid-June and say which of these are we likely to recover or not, and get rid of them from the ledger. Just write them off.
Yeah, which obviously, if something hasn't gone right, you've done a small job, haven't been paid for it, whatever the case might be, don't be wearing that debt. At least the upside, it's not great you didn't get paid, but the upside is that you can claim it as a deduction. So worth doing that. We are just quickly going to touch on our next poll. One thing that we come across all the time is work in progress accounting, WIP. there's a lot of confusion in this area. Unfortunately, it's actually, when you break it down, not a really complex thing to get your head around. But people, for some reason, have a bit of a mental block on it. Some people also think that it is a taxable item. It's not, so don't be misled there. If your accountant is saying that, don't be calculating it or has some views around it, and it might impact your tax, that's not right. It is really important, though, in terms of being able to see your profit ongoing month in, month out. If you're not calculating WIP, then you can't see your profit clearly. So we've got a really neat calculator, and there's an instructional video that goes alongside it as well. So Jules, if you wouldn't mind, can you just chuck that poll up on WIP? If you would like a copy of our WIP calculator and the video, then just say, just tick the yes box to that. If you're all over it and you don't need a hand, then that's fine, no problem. But quite often we see people come unstuck with that one and just really probably just think it's more complicated than it really is. So certainly reach out via that poll if you'd like to get some help with WIP. We might just leave that just for a little bit longer, Jules, and then we can get moving. A reminder to, if anything that Josh and Suze have covered that you're not sure about and you want to ask a question, drop it into the chat as we go, because we can round those up at the end of each section, or you can put your question in at the end of the section as well. We're getting towards the end of the newbie section here, so we might just push on now. Thanks, Jules. So next one is provisioning for tax. This is a smart thing to do, right? I'll just hand over to you for this one, Josh.
Yeah, absolutely. So yeah, rounding up this first section, 2 hygiene pieces that we commonly see are missed, and it's all about sort of avoiding surprises. So the key thing you can do is actually set aside consciously for your tax, and that's income tax, GST, even tax for your BAS. And there's sort of 4 key ways you do that. Firstly is actually conduct regular financial reviews of where you're at in your business, looking at your reporting through Xero and seeing where you are actually sitting. One really simple, practical way of doing this is actually setting up a tax savings account in your business as a side to your general or ordinary business day-to-day account, and actually park the money over there. The other one is, particularly around this time of year as well, talk to your tax accountant around your tax planning, setting a bit of a sort of forward forecast for what tax could look like for the next year as well, and setting aside the actual provision for this tax coming at you. And a bit of an obvious one, but to actually do this using accounting software makes this much, much easier. Something like Xero as well can be clever in that it has a dashboard and you can actually highlight specific tax provisioning accounts, which sort of shows you how tax is accumulating across the year for like GST, etc. as well. Now, as a rule of thumb on how do you provision for it, so there's in the ebook sort of shows you how to come around this, but the quick guide is you set aside 3% of your gross revenue, fortnightly, monthly, weekly, which way you want to do it. That's a decent guide to get you pretty close to covering your tax provision for the year. And it's just a way to reduce a bit of stress in your life, that knowing that you have actually set some money aside for your tax. Now, in a sort of similar vein for that sort of hygiene, superannuation, this is a real core part of the year. We just wanted to throw this in here, that don't forget to pay your super on time. It's only deductible if you pay it on time. Now, what the actual minimum requirement is, you need to pay it by the 28th day of the month following each quarter. So as an example, for this current quarter, you need to pay super before the 28th of July this year, and it's deductible when you pay it. Now, that's the real key thing, to make sure you do not miss that. Also, if you're looking at paying super, part of a tax planning strategy this year is paying super pre-30 June, like the current quarter. If you're using the likes of Xero, etc., don't wait until the very last minute to push the button to pay your super, because it does need to clear through and you have to make sure it gets to the super fund in time. So leave a good week before the end of the financial year if you're hoping to get the deduction this year. That rounds out section 1, Phil.
Righto. So that is our first section for what we call the newbies. So we talked about cars, we talked about home office. We apologise on behalf of the ATO for making that absolutely more complicated than it needs to be. Josh mentioned the ebook. I should have mentioned that at the top. Everyone that registered for this webinar will get a copy of that ebook, and we go into some more of the nitty gritty in the ebook that we just can't get across in the webinar today. But yeah, any questions? I don't think we've got any in the chat, which is fine. Obviously, everyone's getting enough good stuff straight from the horse's mouths. So if that's okay, I'm okay with that too, because we've got a bunch more to get through. So let's do that. So our next section is getting there. So this is where, you probably feel like you've got some of those common hygiene things sorted out from a tax and accounting perspective. Things are starting to take off though. And so what are the things we need to be thinking about from that perspective? And we're going to start with the good old favorite of accountants, having a trust in play alongside a company as a way of moving income around in your family. So let's go for it, Suze.
Yeah, so once you've moved through the newbie phase, you've probably started generating some reasonable income, as Phil said, and starting to now look at what options have I got to help minimize tax and also keep my assets protected. So this is where we'll often find people start looking at ways to separate their personal assets and business assets to make sure the family home is protected should something happen with the business. We'll often find also at this stage that a lot of businesses are starting to take on subbies, they're starting to expand their operations a little bit, might be running a couple of trucks on the road, particularly plumbers at this point might be running 2 or 3 mobile operations as opposed to just them by themselves. So once we get into this space, often accountants will start looking and saying, well, you either need a company, you might even need a trust. Now, there's a few different ways that this can be structured, and we know, and we've seen, plenty of them. A lot of people will put the trading entity in the trust and have what we call a trustee company. So a company will sit over the top of the structure and the business operates out of a trust. The other option you've got is to sort of flip that, and we have a company that's the trading structure, and then a trust owns the company. So the shares of the company are held in a trust. The example that we're giving you here is that example. So where the company operates the business and we have a trust sitting as the shareholder of that business. So a very, very simple example that we're running through here. Say we've got, sorry, can we just go back 2 seconds while I talk through just that structure piece? So say we've got you now earning about 600K in terms of income. The expenses on that's 300, and that includes 100K being paid to you as the business owner. So that's leaving us then with 300,000 in terms of profit at that point. We then say we've got operating expenses of another 200,000. So that's going to leave us with really simple numbers of 100,000 in profit. That profit there does actually have to pay tax if we're in a company structure. So that company would pay tax then at 25%, or 25,000 would be our tax liability at that point in time. What we could do, and if we're in a trust structure, we would have to look at how we distribute that income to the rest of the family. In this case, we're just assuming it's husband who is the business owner, and we've already paid 100,000 in wages too, and a wife of another, and we potentially would pay all of that profit then through to the wife. Now, we've got a couple of options, as I said. We could push that straight through a trust if we're trading in the trust, or we could use the company and we could use a trust distribution or a dividend from the company through the trust to the wife. So on the next slide, then we've got the example of what that tax looks like. Now, if you were a sole trader, so remember the newbie phase when we were still a sole trader, and we assume we've got the 100,000 of wages we've paid to you as the business owner, plus the 100,000 of profit left in the business. That means as a sole trader, you would have to account for 200,000 in income. And that would result in just under $65,000 of tax payable by you. If instead we had this company and trust set up that we were talking about before, you are paid $100,000. Your tax on that is just under $25,000. The company, as I said, would pay taxes $25,000. And if we moved all of that profit through the company to your spouse or partner, we'd actually end up with a very small refund in the partner's hands. That's assuming the partner doesn't work at all. And so you'd actually end up paying just under 50,000 in tax as opposed to the 65 as a sole trader. So saving you almost $15,000 in tax on that example. So this is where structuring can become very important in terms of managing tax and helping to get things better managed and also protect assets. So Josh is going to look a little bit why trusts are still problematic or could be problematic for you.
Yeah, the ATO have this under the microscope. They have for a number of years. The technical thing that they've thrown out there is what they call Section 100A. But what they're basically getting at is if you're going to distribute from a trust to like an adult child or a parent, etc., the core part that the ATO are trying to crack down on is you really do need to make sure the benefit is flowing to that beneficiary of the trust and not just giving them a distribution to get a tax break, but never intending to give them the actual money or benefit. That's the key, because that's not the intention of the trust in the first place. So they're definitely going to be looking at like adult children. So if you've got an 18-year-old and distribute a whole bunch, but never give it to them, that's going to be a bit of a high risk sort of problem for you in the trust scenario. You definitely can still use the kids, but you need to be a bit more thoughtful around how you're using it and why you're distributing to the kids. So for valid reasons. So as an example, you might buy a car for your 18-year-old child, and you go, well, I might try and get a bit of a tax benefit out of that as well. So you distribute that amount to the 18-year-old adult beneficiary and pass the benefit, the actual cash, to that child so they can buy their vehicle. And that's probably the simplest way to sort of look at passing the benefit through. So that's the core thing. Just have it in your head. If you're going to use trust, make sure you are passing the benefit over. Now, in a sort of reverse way, so looking in the company sort of context, it's called Division 7A, but a number of people may have heard of the director loan coming out of a company. So this is, again, assuming you're trading in a company. So the first principle here is that profit and money in a company is not actually yours yet. It is actually the company's money until such time as you are declaring a dividend or actually paying some tax on it. So in the first instance, it's very common for directors to pull money out of a company, which in and of itself isn't a problem. And that drawing of the loan doesn't necessarily attract income tax out of the gates, but you have to be very careful because, again, it is company money, and the expectation is that if you're going to spend that money, it does need to be taxed at the marginal rates at some point. But you can repay these loans. Now, for 2024, there's an interest rate that must apply between the company and the person who's drawing the money, and that's 8.27%. That's up from a few years ago, so it is still a pretty decent interest rate. Now, this loan that I'm talking about, it needs to be repaid a number of ways. Some of the ways can be physically putting the cash back in, which is one way, simple way of doing it. The two other ways, and probably the ways we see more commonly, is you just start taxing that loan across 7 years in whoever's taking the director's actual tax return. So you can either declare a wage and set off against the loan, so you don't actually pay the wage to the director, you set it off, but you pay the tax, the director pays the tax on it, or you declare a dividend from the company. And again, it's a bit of a paper play on it because the money's already gone. So you're declaring a dividend and offsetting it against the loan as a repayment. And you have to do that over 7 years. Now, it's not a terrible thing, director loans. I know there's a bit of noise around, you shouldn't do it because it's awful, but there is actually some scenarios where it can be quite practically useful to use a Division 7A loan or a director loan from your company. And so one example here, this case study, John's company's had a cracking year, excellent cash flows, made a bunch of profit on some jobs. So the company's looking very healthy. Now, unfortunately, the family car's carked it and broken down, and we need a new one. So you're then juggling, do I spend savings? Do I get a loan? And one way you could consider is maybe we take a loan from the company, put it on complying loan terms in the company that we have to pay it back over 7 years, pay the interest on the loan. And again, you may not need to actually physically pay the money back. You could just strategically be declaring a dividend or wage across the next 7 years, pay a bit of the tax on it, and it essentially pays back the money, and you've been able to use the company money to buy the family car. And the interest rate that applies is probably going to be similar to if you took out a personal rate anyway. So it's an effective way of actually using that money. The only overlay to that is be careful. Obviously, you don't want to burn the cash flow in your company. So I'm talking about a case study where you've got excess cash off the back of a really good year, and you could use that. So always make sure that your working capital is always safe at any one point as well. So that's a bit of a Division 7A.
Yeah, and as we move into companies and into space a little bit more, one thing we do have to be mindful of and consider is fringe benefits tax. One of those taxes that we all hate, and I don't think it has got any easier over the years. Mid-80s, this was introduced, and it's been pretty much the same since. I mean, nothing much has ever changed, except some of the rates. And it is something that it's quite complex. It's a really big area of law that's very complex. In a nutshell, if you're paying a benefit to an employee or an associate of an employee, so that could be their partner or child or something along those lines, that it's not paid as cash or wages, you could potentially have a fringe benefit problem. And what that means is if you provide a benefit, and there's some examples there, a car, a phone, meals, entertainment, e.g. the Christmas party, even that actually falls under these provisions, you could end up with additional tax intending to have in the first place. A very, very simple formula of how this works is if you provide a benefit and say that's a $500 new phone, your tax liability under fringe benefits tax would potentially be almost double that. So you're actually providing a $1,000 benefit for the benefit of giving them a $500 phone. It's a really, really basic example. Lots of rules around this, and there are some exemptions. One of the key exemptions a lot of businesses look at is the infrequent exemption. And that effectively means that if you're providing something, a benefit to an employee that is under $300 and it's not regular, so it's not a monthly gift card or it's not a monthly movie ticket or something like that. It might be every so often you give some movie tickets, or every so often you might give an e-gift card or something like that. It will be exempt. So there are ways of getting around this, but it is quite complex. It's definitely having a chat with your accountant if you feel that there could be some things in this space that you might be impacted by. So, Phil,
okay.
Got any more questions?
I don't think we've got any other questions in the chat. So I think unless anyone wants to drop one in there now, we might move through to the nailing it section. We're getting there. We're probably running a little bit long on time here, so hang in there, people, because we're getting to the real juicy stuff now. Not too much longer to go though, so let's go. And our first thing is super. So this is now people are starting to generate some decent profits. What am I going to do with that? Where am I going to put it so that I'm not paying more tax than I need to on it? And obviously, super is one of those. Josh.
Yeah, absolutely. You start turning your mind to that wealth creation piece. What should I be doing with this excess money? Now, with anything related to super, we just have to be careful how we talk about it. So this is just general. I'll just talk about what's possible, but you should always talk to a financial advisor before doing anything related to super. So there's two sort of core buckets of contributions that you can make to super. There's a bucket that we call the concessional or the deductible before tax element. And so that covers both the employer super guarantee, so the 11% contributions, the concessional contributions, as well as any additional personal contributions where you are going to claim a tax deduction for it. So for this financial year, that concessional contribution cap is $27,500, and that encompasses both employer and then personal where you're claiming a deduction. From 1 July 24, that's actually moving to $30,000. They've indexed that right up from the next financial year, just to sort of park that in your mind as well. Now, something came in a few years ago from July 2018 that sort of encouraged people who have probably been a little bit behind on their super historically to sort of be able to top it up and get a bit of a tax benefit for it as well. And they call it the carry forward concessional contribution. So it's a rolling 5-year period where in sort of round terms, if you haven't used your full cap, so it was 25,000 in prior years or 27.5 in recent years, if you haven't used your full cap, then the bit that you didn't use rolls into the next year. So you can get to a scenario where rather than just having a 27,500 cap, you could have something like a $50,000, $60,000 available carry forward cap. So if you've had a great year in your business, then it's possible that you could put 60,000 as an example into super and claim a tax deduction. There are some provisos around that. The first one being your total super balance can't be more than 500,000. So that's all superannuation. So if you've got multiple funds, it's the total of all of them cannot be more than 500,000. That's when the carry forward concessional contribution can be used. So that's something to keep in front of mind. Now, if you had having a chat to your financial advisor and you now got a strategy around how am I going to prop up my super, we've now got the other bucket of super called the non-concessional or the after tax. So it's money that you've accumulated in savings, etc. After paying tax, you can also contribute that to super if you want to. So these caps are a bit higher for non-concessional. So the cap is 110,000 for this year. That goes to 120 next year. And so that's another way of getting some more money in. If you have a particular strategy you're running with your financial advisor and you want to get a whole bunch in, there is a similar concept to the carry forward on concessional on the non-concessional bring forward. This one's more of a bring forward than carry forward. So it's actually looking at the next 2 years worth of non-concessional cap and actually bringing it forward and putting it all in this year. So you put in 3 years worth of non-concessional in 1 year. It does mean you're locked out for the next 2 years, but it does mean you can get a whole bunch into super in one hit in 1 year. That's a bit complicated around super and contributions. And the real key thing is make sure you get the right advice from the tax accountant as well as the financial advisor, and absolutely be careful of going over caps. The caps are very important not to breach them because it ends up having unnecessary knock-on effects from a tax perspective. So that's the broad super.
Now, again, I think, we'd say there, sorry, Julian, again, we'd probably say, considering your commercial aspect of things as well, you would never go and put 300,000 into super without consultation with the appropriate advisors, particularly if you don't have the cash to do it, or it's going to cause you cash flow issues. So it's absolutely worth having a conversation with the accountant and the financial advisor before you proceed with any of those sorts of things. Yeah,
that's a great point, Suze, because once it's in super, guys, it's locked in there for a long time. And if you're early in your career, you're not touching that money for a really long time. So make sure you're there. A perfect point. So that's awesome. Now, complex structure. Now, we're in that sort of scenario now where we're now looking at asset protection, wealth creation, and sort of tax flexibility. And usually that comes around using structures strategically. Like Phil said at the beginning, we're now in this, nailing it section where we've got lots of profits coming off. We may then be, if we're builders, we might start thinking about, I might be doing property development now. How do I do that? And complex structuring is usually comes in as well when you start thinking about retirement and exiting plans as well, and succession planning around that. And as I said, minimizing risk is the key reason why we use structures. And there's a number of different ways you can do this. They're good for creating separate investment vehicles. There's sort of putting pockets of wealth in specific vehicles. And as you can see there, the likes of QBCs here in Queensland or an iCare, etc., it is also important to make sure structures are done correctly so that you don't fall foul of any regulatory requirements or put yourself unnecessarily risk or assets at risk. Now, I'm not going to unpack all of these example structures. This is just, all this is demonstrating this slide is that there are a billion different ways to cut this with a group, and it all depends on your specific circumstances. What are you trying to achieve? Where are your risks in it? Building construction, one of the biggest risky games in town. So we want to be making sure we're using structures that don't connect everything together. So if one entity goes down, you don't take the whole group down. You can just put those silos of structures in place so you can protect yourself, build wealth, and it creates tax flexibility by using those structures properly. So we can unpack that with anyone if they have any questions later on, but that's a bit of you can do it in multiple different ways with structuring.
Look, and it depends on the project you're running as well, which is what we're going to talk a little bit about now. The structure you use could depend on what the purpose is that you want to use your property development for. And where tax comes into play, as well as asset protection, is all about what your intended purpose is for your project. So are you looking at this as a new project that you're just going to buy, maybe do a bit of a reno and then hold it? You might rent it for a period of time. That's going to give you a very different outcome to if you decide instead, oh, you know what, I think I'm going to flip this one. I'm going to buy it, I'm going to reno it, and I'm just going to sell it. So there's a lot of different things we've got to consider when we're looking at a small or even larger property development project, structure being one, tax implications being another. A lot of people don't realize that once you start dabbling in this space, you might actually be generating large profits, yes, but also large tax consequences as a result. And if it's not managed well, you could end up paying a lot more tax than you want to. One of the other things people don't realize is GST can come into play on even just a small project that you're looking at as a flipper, for example, where you are just, as I said before, buying, renovating the project and then selling it. Sounds simple enough. And most people will even say, oh, I'll just live in it at the same time. Main residence exemption, it's all good. And perhaps that's right. But at the same time, you may have an unintended GST consequence. You could have an unintended tax consequence. So there are a whole bunch of factors that need to be considered and to look at when you do come into that space. Main residence being a big one that a lot of people look at. Main residence actually is not a rule under the tax law. It's actually an exemption from CGT. So that's where a lot of people also get things a bit backwards and think, oh, I live in it, therefore it's exempt. Well, actually, you live in it, originally it is subject to CGT. The fact that you live in it could give you an exemption, but doesn't always. So there's a lot of unintended issues that can come into play here. The main thing we want to point out is it's extremely important to get advice at the start of the project, not at the end of the project. If you're at the point of selling the project and that's when you get tax advice, you're probably going to be in for a bit of a shock. If you can flip it and get the advice at the start of the project, you'll probably be able to minimize and maximize your opportunity in terms of how the development plays out. So a few examples we've got here. Flipping, I've already mentioned. Splitting, so people are now starting to look at buying a larger block, subdividing and then selling, or even subdividing, building a 2-pack or 3 and then selling. Renovations are a big part of working out whether you're going to have a big tax issue or not. And that depends on whether it's just small touch-ups, replacing carpet, maybe a bit of paint, or a major reno where you're knocking down walls and basically gutting the whole place and starting fresh. And share housing has also become a really popular thing now, where people are looking at building, renovating, or even buying and doing dual occupancy. So, 2 entry points on a house and splitting it so that it's effectively like a duplex style, but you've got 2 people living in the same property, or 4 or 5 bedrooms are all being roomed and rented to different people. So sharing accommodations becoming very popular in these cases as well. All of these could have very different tax outcomes. All of these could use different structures. So as I said, very important to get the advice up front when you're looking to do these projects.
Yeah, there's a bunch of pub talk around that too. So there's property developments and what's exempt from tax. The main caution is, yes, pub talk will give you some ideas, but don't assume it's right. And
a lot of site talk as well. I had a client call me last week and he's actually doing a 3-pack development. And he said, oh, mate, I was talking to the builder on site yesterday and he told me he did one of these and he got no tax. And I said, yeah, was it the same, or did he actually buy it, do a little bit of an update on the reno and then sell? He goes, oh, yeah, I think that's what he did. So there's very different depending on what you're doing as to, who you're listening to, and the pub talk, the site talk, all of that can really impact where you head in terms of what you're doing. Best advice is talk to your accountant.
Yeah, up front.
Yeah.
Now, self-managed super, I've got to put the obligatory disclaimer up the front here. Self-managed super funds are a very specialist area. The key reason why we've got the disclaimer is that it is actually a financial product. I'm not a financial advisor, but I'm just going to give you some high-level general information around self-managed super, because it might be that part in your journey now where you're thinking, well, maybe this is a good idea. So self-managed super, what does that mean? It means you take full control of your retirement savings and your superannuation. Now, it is quite common particularly when you're in that sort of nailing it phase, to go, well, maybe I need some commercial premises now. So we're no longer home office. We need an actual dedicated space. And super is a very common area to use to actually buy commercial space. The reason why it's so attractive, and I'll get to an example in a second, is your business, because it'll be business real premises as a commercial premise, you can actually rent it from your super fund paying a commercial rent. Now, there are very strict rules around super, so before you even think about diving into going near it, financial advisor and tax accountant, you must talk to them around it. And a really sort of side point is estate planning is a very, very important area. And Suze will talk about some succession stuff shortly to get right if you're going to fold super into your world. You can borrow in super. They call it a limited recourse borrowing. What does that mean? It means that if something goes wrong with the loan, the bank's only got a claim against the property itself. They can't take the rest of the super fund assets. So that's possible, but be careful. The LVR rules in there, and probably not as attractive if you're buying it outside. You just have to be careful of, can you borrow in the first place if you are going to do it? And overall, the reason why people love doing it is very concessionally taxed. So earnings in super are taxed at 15%, capital gains are taxed at 10%. If you're in retirement, it's potential that the tax rate becomes 0. But the key thing is there's a bit more information in our ebook around how you do this as well, buying property and borrowing to do it. But this is just something that we see commonly coming up, don't we, Suze, now as people are getting into that more wealth creation area. Self-managed funds are an area that typically gets looked at. Now, really quick example, you've got your company over here, you pay rent. Again, it has to be arm's length market rent, just can't make your number up. You have to get a third party to confirm the rent. You save tax at the company, so 25% of the rental expense. It gets taxed at 15% in the super fund. So as you can see, there's a 5% or 5,000 tax saving from doing that. The other key perk is you are actually growing a valuable investment asset for your retirement that you actually own. So that's self-managed super fund in a quick nutshell. But as I said, I can't stress enough, get the right advice before you do it.
Yeah. And succession planning, look, we're not going to cover off on this very much at all today. It's more just to highlight, as you get into this nailing it phase of your business life, you're probably going to start thinking about A, retirement, B, do you want to sell? Are you want to getting out early? How are you going to transfer the business? Does it go to next generation? Are you going to sell to somebody else? Maybe someone in the business, or maybe it's a third party. A lot of different things to consider in this space. Again, the key thing is there are tax implications to be aware of, and always seek advice. This is likely going to involve brokers, like accountants and lawyers at this level. So not just in terms of transferring the business, but in terms of your overall wealth protection and strategy forward, moving towards retirement. All of these key advisors are going to be involved in this space for you.
And we know we've seen a bit of a shift. The previous generations, sort of saw retirement as hang up the gloves and there's no value left. As soon as I go, the business has no value because it's all around me. We'd like to think that shouldn't be the case, and that if you get onto this succession planning and exit strategy early, you can be building an asset, not just it just all reliant on you. Yeah, that's right, not just a job. So that is succession planning. I just wanted to quickly cover off before we finish. There's our ambulance as a result of people being on fire.
Maybe you're starting the business, right, Phil? Like it's a heart attack, heart stop.
Yeah, that's right.
The ambulance.
Triage of some sort. So I'll just quickly cover off on this one. If you do have some concerns in your business in terms of mounting debts, we've seen quite a lot of this over the last few years as a result of COVID, people getting stuck in fixed price contracts that have blown up on them from a cost perspective. Quite often we see in these situations they haven't been keeping up to date with BAS payments, and so they've accumulated quite a lot of ATO debt. One of the things the government did a few years ago is come up with this thing called the small business restructuring process. It's open to people who have unsecured creditors of under $1 million. So if you got more than that, you can't buy in on this, or you can't use this arrangement. What happens is as well, you need to have your superannuation paid up to date, so you can't have outstanding super. The good thing is, in terms of other options when it comes to insolvency and the like, you're not handing control of the company over if you go through this ERP process. So you still maintain control of the company. You just have a small business restructuring practitioner get involved to help negotiate with your creditors. And in that negotiation, you end up offering X cents in the dollar to your creditors. Over 50% of the creditors have to agree to that plan. But if they do, then essentially you're making a deal on that debt that, for example, you're only going to pay 20 cents in the dollar to your creditors. We've done a number of these now. It's been a really great facility, as I said, for those people who have been caught in those kind of contracts that haven't worked out, but the ongoing business is really viable. They're just carrying debt, and quite often that debt has been with the ATO. So it would make sense, therefore, to use this legislation and, essentially say goodbye to, 80 cents in the dollar of tax debt. It's also, for those people operating in Queensland, the QBCC don't see it as an insolvency event, so your license isn't compromised as it would be with the other forms of insolvency. Righto, we are just about there. I just wanted to, as we've been talking about, we've got this ebook that everyone that registered is going to get a copy of. So that will be coming out over the next day or so. And we just wanted to run this last poll, if Jules, you could do that, which is if anything's piqued your interest at all along the way today, and you'd like us to follow up afterwards, and just like a second set of eyes to have a look as we come into end of financial year at what your tax situation is like. Now is the time to do that. If you'd like to learn more about Buildxact and find out how it's going to save you, what is it, 80% of the time on an estimate? Why wouldn't you do that? We think it's a great product. We especially love how it connects into Xero and just makes all of the paperwork side of running a business in this space so much easier. But yeah, if you would like us to follow up for a free consultation, tick the right box here. And after that, we're just going to go through any last questions. Jules, is there anything you wanted to add at this point before we kick into any final questions, which we're happy to sort of hang on and do as many or as few as might be there? Jules.
Well, I'll put my email address in there as well, guys. If you want someone to contact directly from Buildxact, you can reach out to me. That should be coming through there. Josh, there was a question from Arthurland. I think Arthurland. I'm not sure how you...
Yeah, about logbook. Yeah, I realised it wasn't to everyone. It was the host and panelists.
Yeah,
the host and panelists, guys. So apologies.
Yeah.
And the chat wasn't working earlier on in the session. So if you try to put a chat request in and it's not come through, then it should be all up and running now for you to hop in and add in. From a Buildxact perspective, if you guys are thinking about using Buildxact, or even if you are using us at the moment, and you want to get a bit of help setting it up outside of what Buildxact do, then please reach out. We've got a bunch of partners that can help from that side. Obviously, Xact Accounting and everything can handle the financial side of things. We're talking more about recipe creation, templates, and things like that. I mention it now in all these sessions because a lot of people don't realize that we have partners. So although it's kind of a bit of a curveball kind of topic to bring up in this particular session, I just like to bring it up because people aren't necessarily aware that is the case. And if you are connected to Buildxact, just make sure you go in and set up the Bunnings price file integration. The way that works is that if you use a timber item or any other item that you've got from your Bunnings price file, you create a template using that item, that goes up in price in 6 months' time, a year's time, whatever. You just update the price and it will flow through in the live pricing. So the idea is that we're getting more accurate quotes. I think 2020, 2021, guys, probably taught a lot of people the importance of keeping pricing as accurate as you possibly can. And even then, I mean, that was getting up-to-date pricing was tough in those days as well. But no excuse now. You can get it, put it into the system, whether it's a manual upload that you get from your supplier or it's an integration directly from Bunnings coming through. I think it's PowerPass pricing, so depending on your rates and everything like that, connect that, get your subby rates loaded in, and then just try and make sure that you're keeping those up to date as best you possibly can. Any other thoughts from you guys?
No, I would echo that though. I mean, that we've seen some real challenges in the market over the last few years in terms of getting, good costs into projects and into estimates. And so, getting that feed in from Bunnings is just fantastic. It means you're not sort of scratching around for current pricing. And so like I would think, like even just using that as a starting point to benchmark what certain products are going to be would be a really great thing to do. Josh mentioned Dex when we're talking about the tech stack. Really have a look at that. There's some other options like HubDoc, but we quite like Dex because of the AI that's built into it, the way it kind of reads the invoice and the receipts really smart, and will make a recommendation on how you want to code that into Xero. And then we really I guess want to applaud Buildxact for the integration that they're doing with Xero as well, because we all want to just cut down on having to manually enter stuff, into multiple platforms. So it's great that the product does that two-way sync these days as well.
Yeah, and one of the things I do want to touch on there, and it was about the succession planning. I spoke to actually, I can't remember where I met him now, but it was basically, I think he was selling his business off to two of the younger guys that either worked in the business or taking it over. And it was, for him, it was really apparent that he didn't really have great systems and processes inside his business to pass that over. And I think a lot of people are in that situation where they're, one-man band, husband, wife team, few people in the business, whatever it is, but generally, sort of it's one or two people completely hands-on the whole time. And everything is up here. And that's why a lot of people, a lot of builders find it really hard to take time off and take time away, because everything is up here. So it's kind of about how you get that all out of your head and into a software, into other people's hands. And it's, the who, not how. It's not how you do it. It's who you get to do it for you. And often, like, Xact Accounting, a perfect example of this. There's marketing people that, work with builders directly. You just want to get people in and around your business that specialize in that area, that can take it off, even though sometimes it can feel like, I'm doing it all in-house and it's saving me money. Most people, that time is worth more than paying someone else to do it. So just kind of keep that in mind. If any of you guys are still kind of not bored of listening to me talk about this, but
well, I was just going to add there, Jules, too. It's just the biggest limiting factor in terms of being able to scale as well. So if you're not, building out these systems and processes, you're not connecting up your apps, you're using, good technology, it's always just going to be you trying to do things manually. And we just actually, I was looking at some data the other day. There's just a clear gap. There's like $1 million threshold for businesses in this space, because that's pretty much all you can handle by yourself in terms of turnover. That's like a couple of decent sized projects. Beyond that, you really just can't scale. Or if you try and scale and you haven't got this sort of stuff in place, then it's perilous. The industry, unfortunately, has got the highest insolvency rate of any other industry in Australia. And it's because we think largely because people just don't have this stuff sorted out. So it actually becomes much simpler day in, day out if you have some of this stuff, squared away and you've got, great processes running. Josh, Suze, anything else you want to add from from the content that we've discussed today, from a tax perspective? It's an interesting time of the year, obviously.
Interesting time. Look, key advice: get our ebook, flip through it.
Yeah.
Anything interesting, reach out, talk to your accountant. Just get the advice around you and unpack it, and just maximize what you could be doing pre 30 June.
Yeah, I think be proactive. Don't wait for your accountant to reach out to you. You reach out to them, set a meeting, go through stuff before 30 June. Once you get to 1 July, it's too late to make these decisions and to sort out any of those extra bits and pieces you might be able to do. So make sure you reach out in the next couple of weeks, have that meeting, have those conversations, and be proactive. You're the one in charge of your business. You're in control of all of that. So make sure you're getting the advice you need from your accountant.
And Suze is saying that because I reckon almost all accountants at the moment can't be proactive. They've got no staff. They're running around like headless chooks. They should be. They should have reached out to you already. You should already be talking about what's going to happen with tax. So yes, be proactive, but also, find an accountant that's going to do the same thing back your way, which is my shameless plug, because that's really the way it should be. You know, like this is a partnership you're supposed to have with your accountant. If you're having trouble getting them on the phone, or, you know, they haven't reached out to talk about what's happening with your tax, and you're just getting sent, you know, documents, then that's no way to run it. All right. I think that's it from us, Jules. Thanks for the opportunity, mate. And it's always good to work with you guys.
Thanks, guys. Really appreciate having on, and thanks to Bunnings as well for getting this out to people and stuff. It's really important, you know, companies like size of Bunnings and you know, us at Buildxact, Xact Accounting, whoever, just try and get this information out to people as best as we can, because we're in this world now where it's an advisory world, and there's a heap of advice out there. Sometimes just getting it in front of the right people. So yeah, Buildxact or Xact Accounting really appreciate Bunnings doing that and getting that out to their audience. And I'm sure there'll be a bunch of people jumping in and listening to the recording of this. So if you are watching the recording, thanks for staying on this far. You know, you might be watching at 1.5 speed or something, but
we'll give you 2 ebooks.
Awesome. But thanks, guys. Really appreciate you coming on.
All right. Good one.
Thanks, everyone.
Thanks so much.
Thank you. Bye-bye.
Cheers.